Pre-approval is the process point where people are ready to kind of take action, I find. I'm Cheryl Wilkes, and I'm a mortgage broker with Dominion Lending Centers, Brokers for Life. When we give you that pre-approval and we send you out shopping with your realtor, we actually know what your credit looks like. We're also collecting all the documentation and getting all the info up front. Then at least we know what income we can use, what down payment is being used, what sources, all that good stuff. It's basically packaging it up to the point that I could send it in with a live offer to a lender. We're ready to go. We've got everything done. Crossing T's, dotting I's. Pre-approvals are free, yes. It's really just the time to collect the documents, have the conversations, and get everything rolling. Even if a part of the pre-approval also included the rate hold, say for example, for 120 days, there's never any fees with any of the lenders that we use, and definitely not through the broker channel to get that first step done. Pre-approvals are accurate to a point. So generally with a pre-approval, we've reviewed, as we said, your credit, we've reviewed the down payment plan, we've approved or reviewed the income documents. If a property is picked that is subpar, we'll call it, so there's major foundation problems, there's plumbing problems, maybe it was used in its previous life for not great reasons. There are times that we run past where lenders will actually decline, and it has nothing to do with the client, it's actually the property itself they've picked. Maybe apartment buildings that have deficiencies that they're aware of, things like that. You know, we can never guarantee an approval on that because there are so many different things. There's also always that random thing where somebody's bank account changes between when we chat with them and when we go because they have to pay for something and now they don't have the money ready to go. Job changes. Last year during COVID was tons of fun with that. Pre-approvals and pre-qualifies are not the same. Everybody has a slightly different take on the lingo, but generally speaking, a pre-qualify is just a starting point. It's a conversation. What do you do? What's your plans? What do you want to spend on a purchase price? What are you going to use for down payment? It's a conversation. We've no credit pulled at that point, and of course we haven't collected all of the documents at that point. That's where I'm giving people kind of a ballpark if they're just kind of getting ducks in a row and planning to purchase maybe down the road, to say, based on the info you've given me, yes, you probably could be in this ballpark. Pre-approval is all of those things collected. We've done credit, we've collected documents. Now we're ready to roll. We've confirmed all that information. Generally, pre-approvals are for 120 days, but again, it depends on the clients and also the lenders. Pre-approval information, we generally need updates on things like, say, job letters or pay stubs that we collect up front. We need updates on those, even if people are purchasing 45 to 60 days later. Every lender kind of adjusts a little bit, but most of them just want updated documents. So the pre-approval and the information, if the client doesn't change anything, they're good for 120 days, but that's generally more around the rate than it is the actual approval piece, right? I've had lots of people where nothing financially changes for them between January and like June. Well, great, you still qualify for the same kind of purchase price as long as rules haven't changed and nothing has financially changed in your income or down payment, right? So it is kind of case by case with people, but in terms of that rate hold component, 120 days is kind of the market standard or kind of that industry standard that most people would recognize. Pre-approvals before selling your home is 110% necessary. Even if you already have a mortgage in place that you wanted to port, which is basically just moving it to the next property, every single time you do that, you always have to requalify for your mortgage. A lot of people don't know that, they are not told that, and obviously not every realtor knows that to tell their client that, right? But absolutely, like 1000%, please talk to somebody before you sell your house. Unfortunately, it happens too often that people don't, and then they realize that they don't now qualify to move that mortgage that they qualified for a couple of years prior, and it ends up being a bit of a messy situation sometimes. Pre-approvals between the banks and the broker channels, absolutely. People will shop around to 6 different places to buy a TV, but they think getting a second opinion on a mortgage maybe isn't so good. Our entire industry is non-exclusive, so you absolutely can chat with more than one person, and in a lot of cases, a lot of the realtor partners we have, and just myself in general, I will tell people absolutely get a second opinion, whatever that is. Bankers can have great rates, they can have good products, and they can absolutely have that. The key is making sure that is the best thing for you. And that's the beautiful part about our side of the industry, is that if you want a 3-year fixed, I don't have one number to tell you. I've got multiple options, and some of them will give you better options in terms of penalty payouts, and some of them will let you move the mortgage to the next property down the road, and some of them let you pay the mortgage out quicker. Like, it's a spectrum in terms of what we can offer. So getting that second opinion is not only sometimes just a little extra of information, it can sometimes also be that like what we're known for, which is like shopping around for rates. Pre-approvals between lenders can differ, yes. We all have the same basic blanketed federal rules. The stress testing rules, for example, that is a federally mandated thing. And in Alberta, even our credit unions follow it. So from the perspective of the high level stuff, no, not a big change between lenders. That being said, some lenders accept things that others will not. Everybody kind of has a slightly different tolerance when it comes to qualifying details. Some lenders accept the federal child tax benefit, for example. That can make a huge amount of difference if somebody's got $500 a month. They don't think it's a big deal, but $6,000 a year worth of mortgage money, that could be the difference between a townhouse and a duplex, or a duplex and a single family home, right? Stuff like rental properties, massive spectrum in opinions on how the lenders will look at those rental properties. Some just don't like them, so they make how they view rentals a little bit farther against the client, I guess you could say, in terms of qualifying pieces. Some of them don't care, so they make it like a little bit more feasible to afford more. So it's definitely that spectrum again of like looking around and saying, okay, what suits this person best based on their home buying goals. So in terms of rental properties, the key for us is the basement suite a legal suite? So anything that's got just a little kitchenette and a bathroom and is functionally usable, you personally sure could have a friend or family member live there that pays you rent, that helps you. In terms of qualifying though, we have to see that the city of Edmonton or the municipality that you're buying in has actually permitted that as a legal suite. They legally allow you to have tenants in there. And it's due to a couple of reasons, is because of the fact that a lot of people were renting out their basements with illegal sized windows, fire hazards, and all kinds of things that put the person in the basement at risk and they maybe don't even know it. You don't want to be renting to somebody putting you in a basement with the little itty bitty 80 size windows. You want the big old window the firefighter can get into, right? There's a lot of reasons for that, but if it's legally permitted, absolutely, we're allowed to use a portion of that expected rent. Even if we don't have a lease, we are allowed to use projected rents towards helping you afford that property. You can get loans to help renovate houses, whether that's a suite or even just do regular upgrades. Lingo on my side is called purchase plus improvements. It's also what we call a renovation mortgage. So generally speaking, lenders will give us up to 10% of your purchase price. Some of them do 20%, but generally it's to a maximum of $40,000 in terms of renovation quotes or work being done. There are a few that do above that. They do the big scale type stuff where people are adding on a second floor or like big renovations. 40,000 tends to be the general lenders, right? They basically generally just want to see a quote up front from a contractor or a professional or somebody that's going to do the work for you, see what it is that you're doing, and to make sure that what you're paying for the work is actually going to add that much value to your home, and then that gets added into the mortgage. It is money that generally gets released after the work is done, so there's always that component of what I jokingly call access to either the bank of mom and dad or credit sources short term to get the work done before the lenders can release it back to you. But it makes a huge amount of difference for people trying to do basement suites or renovate an older house or build a back garage and things like that, that they just don't have the cash for up front.